Light is Britain's far-right conspiracy theory paper spreading hate and vicious lies. No, that's what the BBC say. The Light is the only national newspaper bringing you the real news and informed opinion on what's really going on today. You can subscribe, order copies, submit articles, and read back issues on our website, thelightpaper.co.uk, and see for yourself why the establishment are so worried about the uncensored truth getting out to people every month. The Light Paper. Not far right, just right so far. thelightpaper.co.uk.
Scene script. Have you ever pondered the idea of financial independence and early retirement? The notion of not having to clock in at 9 or wrestle with the daily grind? Imagine a life where you're not shackled by financial obligations or a demanding job. It's not an impossible dream, but a reality for those who embrace the FIRE movement. That's financial independence, retire early. Consider the tale of Jane, a woman in her early 30s. Jane was an ordinary person living an ordinary life. She had a 9-to-5 job, a mortgage, car payments, and a lifestyle that was comfortable but hardly extravagant. And like most people, she dreamed of a life where she didn't have to worry about money. Jane decided to make a change. She began by cutting back on non-essential expenses, saving as much of her income as possible. She invested wisely, focusing on assets that generated passive income that didn't require her to trade time for money. Slowly but surely, Jane began to build her financial independence. She was still working, but she was no longer living paycheck to paycheck. She had a safety net, a cushion that gave her the freedom to make choices based on what she wanted, not what she needed. Fast forward 10 years, Jane, now in her early 40s, had achieved her goal. She was financially independent. She had enough passive income to cover her living expenses, and she no longer needed to work to survive. She was free to retire early, to spend her time as she pleased. Jane's story may seem extraordinary, but it's not unique. It's the story of anyone who has embraced the principles of the FIRE movement. It's a tale of discipline, of sacrifice, and of a relentless pursuit of financial independence. To summarize, the key points discussed today revolve around the idea of financial independence and early retirement. It requires discipline and sacrifice, cutting back on non-essential expenses and saving as much as possible. It involves investing wisely, focusing on assets that generate passive income. But most importantly, it requires a change in mindset. It's about seeing money not as a means to buy things, but as a tool to buy freedom. It's about understanding the true value of time and the freedom that comes with not having to trade it for money. This is the essence of the FIRE movement. It's not just about retiring early, it's about achieving financial independence, about gaining the freedom to live life on your own terms. Like Jane, you too can embrace the principles of the FIRE movement and embark on a journey towards financial independence and early retirement. After all, the only thing standing between you and your financial freedom is you.
Ever wondered how much you'd need to save to achieve financial independence? The answer lies within the mathematics of a concept known as FIRE, which stands for Financial Independence, Retire Early. The most essential number in your journey to financial independence is calculated by multiplying your annual spend by 25. Notice the emphasis on annual spend, not annual income. This calculation is based on the principle that you need £300 invested for every pound you wish to spend each month in passive income. Hence, your FIRE number is also your monthly spend times 300. This mathematical principle is founded on the 4% safe withdrawal rate, as defined by financial advisor William Bengen. He proposed this rate after analyzing the S&P 500, which typically produces an average of better than 10% growth per year when studied over a period of approximately 30 years. Bengen considered factors such as inflation and market volatility. After studying previous market activity, he concluded that a 4% rate of withdrawal per year would provide for a 30-year sustainable portfolio in the vast majority of cases. So to paint a clearer picture, if your monthly spend is £1,000, then your target for financial independence is 300 times 1,000, or £300,000. Alternatively, if your annual spend is £12,000, your financial independence target is 25 times 12,000, which also equates to £300,000. The first step in planning your financial independence, therefore, lies in understanding your monthly and yearly expenditure. Without this knowledge, it is impossible to take further strides towards your financial freedom. In summary, the mathematics of FIRE revolves around the principle of multiplying your annual spend by 25 or your monthly spend by 300 based on the 4% safe withdrawal rate. Knowing your monthly and annual spend is crucial in determining the amount you need to save to achieve financial independence. Armed with this knowledge, you can then plan your journey towards financial freedom. Remember, the journey to financial independence is not a sprint, but a marathon. Embrace the mathematics of FIRE and take the first step towards your financial independence today.
Okay, good morning guys. It is 9:43 on Tuesday the 15th of April 2025, and that means that we have completed 3 years and 2 weeks of this roughly 8-year FIRE journey. Let's start off with a look at where things are at. So currently the current market price for the S&P 500 is sitting at 77.50. The current portfolio value, current portfolio contains 269 shares, and that's worth 20,800. And that represents a return on investment of around about 10%. And as you can see there, the average purchase price 70.48, might as well say. So if we actually look at the chart itself, now the first thing I want to draw attention to is just the blue line that I have superimposed. I can't remember if I did that last week or the week before, but basically that's what that was my best attempt at what I would call a trend line, or a sort of an average price. It's always difficult to get these things at the right angle and indeed in the right place. But basically what I was aiming to do was to try to get as much of the graph above the line as below, and obviously to try to get it at the right kind of a slope. I think we've pretty much achieved that. I mean, it is difficult to be definitive, but and I suppose to a certain extent it's maybe not really achievable. I mean, if you were to say that the market, say for instance, if the market was to grow exponentially, well then obviously you could not represent that with a straight line of any kind, because it would be wrong. It just wouldn't work. But anyway, as I say, this is my sort of what I would call best effort at establishing a trend. And if we look at that, so that goes right back to, what year is that? April 2017. So there's a reasonable sort of span on it. It's actually roughly about 5 years. 7 years or 8 years. 2017 plus 3 takes 2020, plus 5, 2025. So roughly an 8-year span on that graph there. And as you can see, it's probably not bad. I mean, this is the COVID effect, and then the subsequent what they call the V-shaped recovery, and then obviously the market went well. Then there was the start of the conflict in the Ukraine, and then we continue on from there until things started to really shoot up again. And then of course we've had the Trump tariffs, which I think is the catalyst for this most recent pullback. So obviously you can see my trend line is coming to about here, which would be around about 75.90, something like that. Where it hits sort of, well, here, let's do this, right? So we just to be a little bit more precise, 75.71 roughly is where my trend line hits the sort of today's date. And so the actual current market price is 77.65. I'm not sure why this is showing 78.03 at the side. Let me just wonder, is it worth refreshing the page? Because as far as, hold on, what is this blue one then? What's that? Isn't that just, that's where our average, that's our average purchase price, is the blue one, as far as I know. Yeah, because that gives us our result, as you can see there. The green line should be the current market, current purchase price, but I don't understand why it's showing up at 78.03 when on the right here we've got 77.65. That's a bit odd. Let's tell you what, let's refresh the page. It's not going to do any harm. Okay. Right, so nothing has really changed. We're still looking at the same values. Okay, not to worry. Moving swiftly on. So I don't know actually if anybody noticed, but when we started, the market was down 0.5%. Currently down about 1/3%. So it's actually come up very slightly. And I suppose actually where the market is at the minute is, it's probably difficult to see on YouTube, but there is actually a very small green candle just above the mouse there. That's where the current price is. Okay, before we have a look at the notifications, I just want to show you an advert for Monzo.
I want a bank that makes money easy.
That sounds perfectly reasonable.
And you are?
We're a bank called Monzo.
I want a bank that shows me what I spend instantly.
No problem, just give us a go. See?
Can you make splitting bills easy?
Super easy, check this out.
But it's a real faff to sign up.
It takes less than 10 minutes.
Ratio.
You're on.
Can I talk to a real person 24/7?
Of course.
Even now?
Yep.
Even now?
Anytime.
Can you tell me when I'm running a little low on cash?
We certainly can.
Cool. Can I afford these?
You certainly can't, sorry. Can't afford that either.
That's a real shame.
Not really. Time's up, how'd you get on?
It's a draw.
Can you help me save for my next holiday?
Oh, how about you set up a savings spot in the Monzo app called Barbados, baby?
Thanks for listening, Monzo.
We're all ears.
We can go now.
Rude. You make Monzo Monzo.
Okay, please see the affiliate links in the description for the video if you're interested in Monzo or indeed Smarty. That's my mobile provider. And let's have a look at the notifications. So, First off, MC under pressure, LVMH. I feel as if I should know what that stands for, but just at the minute off the top of my head, dropped 6% after posting a decline in Q1 sales, missing 2% growth expectations. As you might say, not massive growth expectations, but they've missed it nevertheless. Biggest stocks before earnings: Johnson & Johnson, Citigroup, Bank of America, Applied Digital, PNC Financial Services Group. Actually, just to come back to that first one and point out that the vast majority of stocks and shares were in the red this past week or fortnight. So quite honestly, I mean, if a company had been on target to just meet some sort of a forecast, it's really no surprise if they didn't. And that's probably no real reflection on the company itself, or indeed its long-term profitability or anything else like that. It's simply market reaction. So let's continue. Bull takes off. Webull, is that? Or Webull? I don't know. Anyway, they soar 300% in a breakout move after Friday's SPAC merger. NASDAQ debut. Honestly, I would be very, very, very loath to invest in something that has jumped 300%. I'd be much more likely to take a pessimistic view and short it, quite frankly. Apple up 6% as Trump temporarily exempts smartphones from reciprocal tariffs. Okay, I wasn't aware of that news. That looks to have happened in the last day. And so as if you've been following the news, or maybe if you're looking back on this historically, Trump had basically imposed pretty costly tariffs on a lot of other countries, and in particular on the likes of China. I think some of the tariffs were in the region of 100%, so in other words, basically doubling the cost of Chinese products entering the US market. And it seems to me as though, from listening carefully, he wanted to engage in some kind of a negotiation with the different countries and continents, and basically, I suppose what I would put it, that he wanted to renegotiate the terms of whatever trade deals already existed. And I'm not sure if we can draw any conclusions from this, or if it is simply to do with pressure internally from corporate America, complaining about the fact that much of the products they produce is dependent on imports from other parts of the world, and the imposition of the tariffs that had taken place was going to have a massive impact, possibly on their supply chain, but certainly on their profitability in future. Finally, we have the upcoming Easter holidays. Let's have a look at the detail on that. There will be amendments to trading hours. Due to the upcoming Easter holidays, there will be amendments to our trading hours. The 18th of April, all markets will be closed. The 21st of April, all European markets will be closed. Full trading schedule could be found in the link below. Let's just have a look-see. So, 18th of April, everything, as you can see there, is closed. 21st of April, the US is open. So that's going to mean that the S&P 500 is going to trade, but those parts of the S&P 500 that are quoted on the London Stock Exchange in the UK, for instance, will essentially be frozen until markets reopen on the 22nd, I assume. Is that Tuesday? It is. Austria, Spain closed on Easter Monday. Euronext, so Belgium, Netherlands, France and Portugal all closed as well. Germany likewise, Italy and Switzerland the same. So it is only the the markets in the Americas that will be open on the 21st, just Canada and the US. Let's go back to where we were. Why is that not doing it for me? Let me see. Okay, so that's the notifications, and then obviously we've come down to, actually I suppose it's worth just looking at that. So 8 days ago was the last time I did a live broadcast, so just over a week, and at that time we were purchasing at £71.20 per share. Probably worth looking back, actually. Just let's have a scroll on down here. I'm just looking to see what the highest price I can see is, and I think it's this one. So 2 months ago we were trading at £93.32 a share. It dropped gradually back to £90, then up a little bit, 92, 92, back to 90, down a bit to 89, then a bit of a fall to 82, and then we had 82, 83, 82, and then the big drop between 2 weeks and a week ago, down to £71.20, and obviously today we are going to be trading for a little bit more than that, £77.60 currently. Let's go ahead and do our weekly market purchase. If you follow the channel, you'll know that I normally put, well, not I normally, I always buy £120 per week. This is theoretical money, purely to keep my own investments private, but I am investing a similar enough amount on my own behalf in a real trading account using Trading 212. This is the practice platform, and this is going to buy us roughly 1.5 shares today. So we're buying the Vanguard S&P 500 exchange traded fund, and we will buy that as a market buy, so there's no stops, limits or any other conditional operators being applied here, and when we send that through we'll see if we do get 1.5, and what price we get it at. Now I'm not going to bother mentioning the average purchase price because it's so close to the to the market value that I don't expect it's going to change very much, and quite honestly with the volatility that there is at the minute, it is kind of irrelevant, I believe. So we have sent that through. We have bought 1.54 shares, and we got them at 77.60. So let's have a look and see if things have updated. They appear to have. So currently we own 270 shares, 270 and a half, and those are worth 21,000. And so the current return on investment, 10%. Average purchase price 70.52, so going up very slightly. And if we have a look at the stats here, as you can see, on the day the market is down slightly, roughly 1/3%, maybe 2/5%. And as regards the 52-week range, it is kind of trending more towards the middle of that range compared to where it had been previously. And currently the volatility appears to be quite a bit less than it had been, so it does appear as if there may be a little bit of stability creeping back in. Here's some other figures for people that are into that. I personally am not. Just to have a little look at average annual return figures, as you can see here, I think these are literally just going back these periods of time. I don't think these are average figures or anything like that. So compared to this time a year ago, the market is up almost a quarter. Compared to this time 3 years ago, the market is only up 8.5% or so. Compared to this time 5 years ago, it's up 14.2%. And compared to 10 years ago, actually, I'm going to say that, no, sorry, these are average annual returns. Okay, so yeah, so for the last year, the average growth has been 24.5%. In each of the last 3 years, if you were to average out where the market is now compared to where it was, then you're getting 8.5%. The average for the 5 years is about 14.5%, and then the average for 10 years is 12.7%. So that's actually, if you look into what J.L. Collins says in his book, The Simple Path to Wealth, and indeed other people, it's really only once we get to this 10-year figure that you're actually seeing roughly what we would expect. It's usually a little better than 10% per year. I don't want to give a figure any higher than that because I think it might be a little bit misleading. But that is not too far from the sort of figure that J.L. Collins would have made reference to in The Simple Path to Wealth, and indeed online. You'll find him on YouTube if you type in his name. And of course he has a blog at JL Collins NH. I can't remember if it's .com or .something else, but if you look for JL Collins NH without any spaces, I'm pretty sure you'll find that pretty easily. That is going to be it for today, guys. If you have been watching, thank you for your patience. Apologies if this appeared a little hesitant at times. I am just sometimes trying to make sense of what I'm seeing on screen, although normally it is pretty straightforward, and as I say, today just seemed to get caught out with a couple of things there that I wasn't expecting, but it has nothing to do with the fire journey. It's just simply how things have been represented on screen. If you're interested in following the journey, hit subscribe, and if you particularly like this one, which would surprise me, give it a thumbs up. And of course, if you've got any questions, comments or criticisms, leave them below in the text box. Thank you for watching and have a great end to your Tuesday. Bye for now.